Here are 5 potential multi-bagger stocks. Let's get into them right now. First one, HPQ. Now, really quick, before you ask, for those of you who are new, multi-bagger means they can go up X times. So a 10-bagger would be 10X the price. Now, HPQ, you might be a little perplexed going, but Paul, HPQ is a declining business. Their revenue is down. Look at this. Look at their income over the last few years. Trailing 12 months is $53.7 billion, $63 billion in 2022, $63.5 in 2021, 56. So you sit there and say, well, yeah, but look at the last 10 years. The revenue is down over the last 10 years. Keep in mind, you can still have a multi-bagger even with declining revenue. That might sound counterintuitive, but I'll get that in that shortly. Now, I own HPQ. At one point, Warren Buffett and Berkshire Hathaway owned HPQ. Do not buy a stock merely because somebody else that you know has the stock. I'm trying to teach a process here that you can apply to your own investment style. HPQ is a declining business. One big part of their business is what? Printers. Who's printing these days? I mean, printing is declining business. Even personal computers at one point were a declining business. There might be a resurgence of it. Guys, everybody thought the tablet was going to take over. Maybe not. Now, even though it's a declining business, this is the revenue of PC monitors and projectors market worldwide from 2018 to 28. There is growth from here, guys. $38.5 billion to $42.74. Not huge growth, but there still is growth worldwide. And even in growing economies like in India, China, Africa, PCs, personal computers will be more and more in demand as they grow their economies. But yes, the news on PCs and printers are not good, and HPQ has a big investment there. Hopefully, they can use their free cash flow to not only buy back those cheap shares, but also make investments in other areas that can expand their free cash flow and divest from areas that are eating their free cash flow up. So let's check out HPQ overall. What is HPQ? Personal computing, printers are 2 of their main 3 businesses. They sell to major corporations, individuals, institutions, governments, etc. They're all over the place. Now, from an 8-pillar perspective, decline in net income, decline in revenue. And you might sit there and go, Paul, this stinks. Well, look at their return on invested capital, 80%. Because they're buying back shares. Look how many shares they bought back. 31.5% of their shares in the last 5 years. This is such smart capital allocation. They're taking their cash flow and buying back shares. And the best part is their free cash flow multiple is 11.8 or 11. That's what's great. If you can buy back cheap shares, and even if the business is declining, you can still make a great multi-bagger purchase. Let me show you right now. Now, here's the information on HPQ. $35 billion market cap. Number of shares outstanding, 984 million. Free cash flow in the last 5-year average is 3.8 billion. Let's say they have a declining free cash flow of 3% per year. And let's say stable free cash flow multiple is the market average of 15. Some would argue against that. I get that. But right now, the stock price is $35.57, selling for a 5-year average free cash flow of 9.2. But over time, it's going to increase to 15. Over a 15-year period, you can see a 10% price appreciation in the stock just by buying back cheaper shares, even though the market cap only goes up by 0.1% per year. That's the power of buying back cheap shares. I will also show you one of the other 5 stocks, how this can be very beneficial because it's selling for 5 times its free cash flow. So HPQ, in my opinion, is purely a play on can they figure out a way to stabilize the business and buy back cheap shares. If they can, this could be a potential huge multi-bagger, taking the stock from 35 today to 140 in 15 years. Not a huge gain, but the point is making a gain in a declining business because the market's perception of it could be very negative. But again, this is not for the faint of heart. This business could turn around. This business could get even worse. What's the future of printing? Remember, printing is a big part of their business still today. So you've got to be aware of that. And this is not a company that you want to buy if your thought process is growth, growth, growth. This is not a growing business. That's very key to understand. Now, guys, if this stock fell in half to a market cap of 17.5 billion and a price of 18, look at this kind of growth you can get. You can get a price appreciation of 20% per year. That's what's key to understand here. is that the perception driving the stock price could actually be better for investors if HPQ still buys super cheap shares back. Now, even though I put in that negative 3%, look at analyst estimates. They have not even negative 3% in here for their earnings per share growth, basically even for the next 3 or 4 years. And revenue growth, slightly positive, 54 to 57.5. Again, not a big grower, but if they properly allocate their capital by buying back shares, they can do a great job for investors. But one thing along the way is they pay this dividend of 3%. HPQ, please get rid of this dividend. If your stock keeps falling in price, yes, it'll be attractive if it fell in half to be a 6% dividend yield, but stop paying that dividend. So let's go to our stock analyzer tool to look at what's the price of this company worth to us. Now, I did revenue growth over the next 10 years of -3, 0, and 3%. I did profit margin of 5, 6.25, and 7.5. And if you look here, their free cash flow is slightly above. So I put 5.5, 6.5, 7.5, equating it on the top side. For PE, I put a super low PE of 10, 13, and 16, same with price to free cash flow. And for my desired return, I'm going to sit there and just put the market return in for you to decide what your margin of safety will be. For margin of safety, this desired return needs to be above 9 or 10% because the market can get 9 or 10%. And in order to buy a business, an individual company, especially one that's declining, you need to have margin of safety in there. Hit the analyze button. I have a low price of 22 to 24, high price of 64, a middle price of 38, and this includes the dividend. So if you're the kind of person who's okay with a declining business, but one that buys back their shares at very opportunistic prices, this is a company you might want to look into. Stock number 2, British Tobacco. Guys, again, I own this company, but don't buy it just because I do or anybody else does. Now, the exciting part about BTI for a lot of people is this dividend. 9.3% dividend yield eats up $6.5 billion of their free cash flow. Now look at their free cash flow. This is what's interesting, guys. 11.7 billion average over the last 5 years, but last year they did 12.9 billion, an increase in free cash flow. Now, guys, the smoking market, this is a declining market in our economies, but in expanding economies, there are still people smoking. I saw a study the other day that regular smokers in the US are under 20%, but people who smoke a smoking product of some sort every year is over 38% of the US market. That's a lot more than expected. But regular smokers is declining and has been declining for decades. British Tobacco has been around since 1902. And obviously back then versus now, the smoking market's very different. But now we have vaping products, which British Tobacco is involved with. It has great free cash flow. Again, you know what I'm going to say, guys, stop this dividend. You know why? Look at this price to free cash flow, 5.5. 5.5. They should be buying back their shares like crazy. So let's go look at the 8 pillars here and see what this looks like. A lot of X's, 4 X's, 4 check marks. PE ratio is high, but remember, the reason being, if you look over here, they reported an $18.3 billion loss last year versus cash flow of 12.9. So that was probably a write-off of some sort. So I'm ignoring that. Bad ROIC. Take some investigation there because I don't know why that is. But net income is down because of that same issue. But cash flow is up. Free cash flow multiple is very low. Buying back 2.4 shares. Guys, this to me should be an X because this is absolute highway robbery. British Tobacco. I'm hoping, the reason I own their shares is I'm really hoping that they take their heads out of their asses and realize, oh my God, we have such a low free cash flow multiple. We should be spending every single dollar buying back shares. Look at their market cap, 70 billion. Look at their free cash flow, 12.9 billion. They could buy back all of their shares in a matter of 5 years. These are analyst estimates on earnings per share for BTI going forward. 468, 496, 527, 573, 611. Does anybody see anything declining? I don't. So this might be an example of the market just saying, we hate tobacco. I don't blame them. But let's go to our sheet now and let's look at this. $69.5 billion market cap, 2.23 billion shares outstanding, and free cash flow of 12.89. I'm going to assume 3% growth rate in their free cash flow, okay? Now, I'm going to also assume a stable free cash flow multiple of 15, and the current price is around 31 with 5.4. So every year, that free cash flow multiple will increase. If they used every single dollar of their free cash flow to buy back shares, look what happens. price appreciation of 26%. The stock price will go to $808 from $31 if they buy back shares properly. And I may sit there and say that doesn't happen. For those who don't believe that, go check out NVR, go check out AutoZone, go check out O'Reilly Auto Parts. These three companies bought back cheap shares. Yes, they were growing businesses, but their stocks went up 100 times, 50 times, whatever it was, even though the business only went up 5 to 10 times. That's the value of buying back cheap shares. And this company is so inexpensive in terms of its free cash flow multiple. Hopefully at some point, the market will see the value in this and British Tobacco will start buying back these cheap shares. Now, on our stock analyzer tool, 10-year analysis, I actually went to revenue growth of negative. I'm going to change that real quick. I'm going to go -2, 1, and 4% revenue growth. I did profit margin of 20, 24, and 28, which I'm just going to ignore right now because their profit numbers recently were completely skewed. Free cash flow. Look at their free cash flow. The percentage is actually getting better as time goes on. But I put in 30, 33, and 36. For PE and price of free cash flow, I put 12, 15, and 18. And again, my 9%, no margin of safety return. I hit the analyze button. Let's focus on free cash flow. I have a low price of 45, high price of 103, middle price of 68. Again, don't buy this company just because of these numbers and because I have it or somebody else has it. If it's something you feel comfortable with, do more research on it because I think this has a lot of potential. But the key here is British Tobacco needs to start buying back shares. Yes, the dividend's attractive. Yes, it's a great way to feel warm and fuzzy as you're getting a check from the company, but that is not a good use of their cash. They need to be buying back shares. Stock number 3, Adobe. Guys, I love Adobe. I consider Adobe to be one of the best software businesses out there alongside Microsoft. This company makes a great product. People love them, and they have subscription-based business now that's really driven their revenue very, very intelligently. I love this company. On top of that, they report a free cash flow of $6.5 billion last year, 6.15 in the 5-year average, versus net income of 4.8 and 4.6 billion over the last 5 years. So they're reporting a higher free cash flow than their net income. Another thing, $204 billion market cap, $210 billion enterprise value. That difference of $6 billion is essentially their net debt after taking the cash and everything off of there, so they can pay it all off in 1 year. Great balance sheet businesses stand the test of time. Look at this return on invested capital. 19% over the last 5-year average, 23% last year. This is a company that gets a great return on the money invested in their business. You know what the crazy part is, guys? They're selling for 31 times their free cash flow multiple. And I like the company. I'm going to show you why even further. This company did an all-time high of $700 on November 22nd. It's currently at $445. Hit a low of $417 about a year ago. But let's go check out the 8 pillars here. All check marks except for the 5-year PE and the 5-year price of free cash flow. Okay? Great return on invested capital, buying back shares. We'll get into that. But one thing to keep in mind, guys, is their profit margin and their free cash flow are different, as I said before. So I'm going to focus on the free cash flow because it's the true lifeblood of the business. And I want to make sure I focus on that. Let's see what analysts are saying. Look at the EPS growth by analysts. 1839, 20.78, 23.87, 26.8, 30. That is double-digit growth every single year, according to analysts who have their own bias involved in these companies. Let's look at revenue. Double-digit growth from 21.9 to 33.3 billion. Guys, a lot of growth potential here. You should pay a premium for companies that have growth potential and a high return on invested capital. And if I asked you, who makes the best imaging software, things like that, Adobe's up there. And that's what's key to remember here. So I look at this going, it has all the makings of a great company, so you should pay a premium for it. So let's go pull up our stock analyzer tool. So guys, here's a 10-year analysis on Adobe. I did 6, 10, and 14% revenue growth. Yeah, I did profit margin. I'm not going to look at that right now because look at their free cash flow. 38% over the last 10 years, 38.7 over the last 5 years. So I'm doing 38, 40, and 42 because I assume that as they grow, their free cash flow can be a bigger and bigger piece because of what a high gross margin they have is. Now, PE and price of free cash flow, it deserves a premium to the 15 that the market gets. 18, 24 on the high side, 21 in the middle. I would understand completely if you said 23 or 24 in the middle. I get that because it's a high quality business. And again, we did the 9%, no margin of safety return, hit the analyze button, focusing purely on free cash flow. A low side of 356, a high side of 900, a middle price of 567, 445 is a low. So guys, this company, based on a discounted cash flow model at the current price, 12% per year. If it was able to do this for the next, call it 20 years, that's doubling 3.3 times. That is a 9 to 10 bagger over the next 20 years. That's what the key here is with Adobe. But remember, there are going to be fluctuations. Look at the fluctuations this company has. That's what's key with investing, guys. Look at these fluctuations. It went from a high of 700 to a low of 274 back in September of 2022 after the tech bear market we had that year. But what changed in the business? Nothing. The business was the same. The business got better. But what happened in the market's perception of the business? It changed. Perception of tech changed. That's what's key about investing. Everybody has the brain power to see these multiples. Everyone has the brain power to understand free cash flow statements, income statements. I'm here to teach that. But most importantly, I'm here to teach about the stomach. Does everybody have the stomach to buy stocks and hold them? Guys, every company, no matter what it is going to go through its fluctuations. In order to make a lot of money, you need to be able to stay into them. And not only that, when the price becomes better and better, and the story stays the same, the story that you see, not what the market tells you. Because remember, when the stock falls, the market's going to tell you, the news is going to match the stock price movement. But that's not necessarily reality. Just like when a stock is going up, the reality isn't the same. Look at GameStop, prime example. That company was up 80% today. Now it's up 30%, something like that, just because Roaring Kitty just goes get a $200 million position in it. That's not rational. And you've got to remember that it happens on both sides of the market, up and down. So if you're able to get that, if you're able to understand that, and it's hard to do when you're all by yourself, that's why we have this community of thousands of like-minded investors who can help you, and you can help them become better investors. So if you're interested in joining, getting all of our tools, and getting this community, click the link below. We have great trial options for you, so go check it out. I guarantee you, it'll make you a better investor. Stock number 4, Rowe Price, a company I own. You know the rules about companies that I own. This stock hit a high of 224 back in August of 2021. It's now at 117. It got as low as $87 back on October 27th of last year. Not very long ago. Look at that fluctuation in price, guys. 224 down to 87 in a matter of 2 years. In a matter of a year and a half, back up to 117. Pays a healthy dividend for those who love dividends, 4.3%. And guys, look at this market cap, 26.25 versus enterprise value of 26 billion. This company manages money. But the key here is that you've heard me talk about where I think stocks are going for the next 10 years. And there's going to be a lot of fluctuation here. Let me show you. This is T. Rowe's assets under management over the last 15 or so years. But guys, look at 2021 of almost 1.7 trillion. We had that bear market goes to 1.275 and growing again. This is a company that will fluctuate wildly as the markets go down. If what I think is going to happen over the next 5-10 years does happen, there will be a lot of fluctuation in this company. The question you have to ask yourself is, do you want to own this company for a long period of time? That's the real main question there. And if you see right here, look at the market change versus net flows of cash. Big drop right there. Big drop. Even here, this year, 2023, net flows of negative 81 billion, 82 billion versus $250 billion in market change. So there's things to keep in mind here. You're looking at the fundamentals of the business. And when I see this company, and I see the fundamentals here, I get very excited. Gross margin of 50%, bottom line margin of 30% to 33%. Healthy dividend. I don't know how they afford it based on last year's free cash flow, but I think the dividend yield's got to go, especially the stock falls. Now, another thing, analyst estimates aren't pretty here. 9 to 874 in the next 4 or 5 years, and assets under management, revenue, 7.3 down to $6.7 billion. All right, this thing is beaten up quite a bit. Now, I got lucky and bought it at sub $100 prices. If you look at my stock analyzer tool on where I like the company, remember, again, don't just do it because I do it, but I look at these prices and I go, okay, This assumes 10-year growth based on 3, 5, and 7% revenue growth. I kept my free cash flow and profit margin. As you can tell, free cash flow margin is lower than the profit margin. And I did 15, 17, 19. I'm going to focus here on free cash flow because it's the lower number and the one that matters the most. 148 is my middle price. That's still pretty good. Now you sit there and say, hey, at 117, is that enough margin of safety? For me, it is not. I'm not comfortable with that because I look at it going, there's going to be a lot of fluctuations in value based on the business growing forward. But I do believe this is a good company that I can own for a very long period of time, that if I buy at much cheaper prices, even though this current price at 117 shows a return potentially of 12.38% based on discounted cash flows, I'm still not comfortable with that because I look at it going, there's going to be a lot of fluctuations in value for this company. Revenue is going to change a lot based on how the market does. And the market has some sort of massive correction and stagnation for a while, I need to get my value based on buying at a cheaper price. So even though I'm in the green here with a pretty good return, I'm still going to be cautious and wait, because if the market does have a bear market, which eventually will, the stock will get hit hard. Final company, Disney. Now, guys, I've talked about Disney before. This is not a company that I'm going to look at the balance sheet, understand it. I'm looking at this company saying, look at these margins. The profit margin in the last 5 years has been 2.4%. Last year was 1.9. Now let's go check out how they were before COVID. And that's the real question we have to ask ourselves. Before COVID, what was their profit margin? Well, they did $70 billion in 2019, and they had profit of $11 billion. That's 14%. 2018, $59 billion, profit of 12.6 billion, which is 15%. The next year, $55 billion, profit of $9 billion, another 15%. So what am I getting at here? It's actually 15, 15, 15. Recent profit's been 2%. Now, I know a lot of people out there will sit there and say, well, profit margins don't mean revert. They actually do. And especially when it has new record growth here in revenue. They have Disney Plus. They have a great library, a great history. This company is not going away. And I think they're just in a lull right now. And once their profit margin rebounds, I think it's going to be an explosion in the stock price. But this stock has meandered around from a high of 202, all-time high, back in 2021, to a recent low of $78. And you saw in our videos in the past, this is a company that I own. This is a company I was buying a lot of shares at, sub 85. Don't do it just because I do it. But this thesis, I think, is sound. The thesis is based on this company getting back somewhere in the 10 to 15% margin range. And let's look what analysts are saying. Look at analysts. They're expecting $4.78 per share in profit this year, going to $7.67. Double-digit growth. And revenue growth, 3 or 4% a year. Makes sense. It's a huge company. They already all over the world. I don't think their revenue growth is going to be astronomical. So let's pull up our stock analyzer and see what I've done in the past for my assumptions. Now, guys, I didn't even go back as my middle profit margin numbers to even 15%. I just went to 12%. I did a low of 9%, high of 15. Guys, my multiples of 18 to 24, I think you could argue much higher multiples, much higher. It's still Disney. If I gave you $200 billion today and say compete with Disney, you'd probably fail. $200 billion, that's the moat that Disney has. And the 9% return, hit the analyze button. I got a low price of 75, high price of 205, middle price of 128. And I look at this going, this is a 12% return based on today's price. Now, guys, I've shown you 5 stocks today that I think have some major multi-bagging opportunity, but I haven't really covered everything that matters in buying a stock. So go watch this next video where I cover all these things, as well as the things that no one's really telling you out there. When I say no one, I mean the masses. Thank you very much for your time.